I'm Jason Stipp from Morningstar. Money market funds got a bit of a black eye in 2008 when the reserve primary fund broke the buck. Its net asset value went below $1, meaning that investors actually lost some of their principal, which is not something they were used to doing in a money market fund. In response to that, the SEC has adopted a new set of rules about money market funds that went into effect last week. Here with me to talk about the details of that is Morningstar's Christine Benz. She's Director of Personal Finance. Thanks for joining me, Christine.
Jason, nice to be here.
So this was a pretty big deal when it happened back in 2008. There was a lot written about it. Just now, some rules from the SEC are going into effect. Can you outline what those rules entail? How are they trying to fix the situation?
Well, they're trying to make money market funds safer. So there are a couple of new rules. First, money market funds must keep more money on hand in investments that can be easily liquidated. And there are also new limits on how much they can hold in less liquid securities. So just 5% of assets can be parked in securities like that. And overall, the credit quality restrictions as well as maturity restrictions are getting tightened up and specified. So I do think that money market funds already safe before will be even safer than what they were in the past.
So on the face of it then, these investments which are supposed to be safe could be even safer. That sounds like a good thing. Are there any downsides then to the rules that the SEC is adopting?
Well, yes, and the key one is yield. So investors in these funds have been pretty strapped. They've not been earning much in the way of yield. Some fund shops have gotten out of this business altogether because once you factor in the costs of running the fund, it's just not been a good business for them to be in. It's not been profitable. So I think that you'll continue to see some downward pressure on yields as some funds are required to swap into higher quality, higher liquidity securities.
So it's always sort of that risk reward, so it may be safer, but you're just not going to get paid as much.
Exactly.
So, given that, yields already are so low and, now they could go even lower for some of these investments, do I have any other options then for where to park my cash?
Well, a few ideas. First of all, you don't want to hold any more in cash than you absolutely need to at this point. So for retired people, I usually say you want a minimum of 2 years worth of living expenses in true cash. And people who are working would want 3 to 6 months worth of living expenses in cash. And beyond that, you can think about venturing into a high quality short-term bond fund, perhaps with a portion of the safe sleeve of your portfolio. And then also I've been hearing from readers about some different ideas beyond money market funds. Some people have been talking about getting into, say, 5-year CDs, which offer significantly higher yields than money market funds. And even if you do have to pay a penalty to get out of that CD prematurely, that you may still be ahead with the yield that you're picking up before you need to get out of it. So that's an idea. Credit unions are another idea, a way to pick up a higher yield. You may not be able to avail yourself of some of the bricks and mortar features that you get with regular bank accounts, but that's another idea for people who are looking for yield.
Great. Well, thanks for the update on the funds, Christine, and for the ideas.
Thanks so much, Jason.
For Morningstar, I'm Jason Stipp. Thanks for watching.